Hey everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, and it is both my distinct pleasure and great pride to announce to you that 2021 is going to bring a lot of great enhancements and improvements to not only our FastGraph research tool, but we're also going to be launching a very exciting new product that we've had a lot of demand for, and people have asked us for help on this subject. Number one is FastGraphs is going to be migrating to a much more powerful software that's going to give us significantly better loading times. And we're also going to be able to utilize that software so that we can more effectively and efficiently add important features and benefits to our subscribers' behalf. And that would include having a full set of the company's financial statements available and having the ability to look at those financial statements in a unique way. And that actually brings me to the announcement of the FastGraphs Value U Academy. This is a new product that we're going to be launching in 2021 and that we're very, very excited about it. So let me go ahead and just give you a brief introduction to what the FastGraphs Value U Academy is all about. The FastGraphs Value U Academy will have a very comprehensive syllabus where we're going to teach you and help you learn how to properly value a business so you can make more profitable long-term decisions on your common stock investment portfolios. Because we all know that businesses get their value from the amount of cash that the company generates on behalf of its stakeholders. More importantly, perhaps stocks simply represent ownership interests in those businesses. Therefore, the trick to long-term success, at least in our opinion, is to buy the stocks when they are aligned with the intrinsic value of the business behind the stock. And the FastGraph Value U Academy is going to help you do that. It will not only teach you how to value businesses, but also how to read and understand a company's financial statements, thereby taking the mystery out of investing, a question a lot of you have asked. It will also simultaneously provide you with the necessary tools, and that's one of the things that's really going to differentiate us. We're going to show you how to read financial statements and then give you the tools so that you can manipulate the important metrics in the financial statement and organize them in such a way that you can efficiently and effectively analyze whether you have a good financial statement or a bad financial statement. We're going to be offering a very comprehensive curriculum that teaches finance and key investing principles. And as I said earlier, try to do this in a fun and visual way that is easy to grasp and understand. Now, we have a full syllabus that this particular slide presentation will be covering, and I'm not going to go over it today because it's for a different video and a different topic. What we're going to do today is try to help answer one of the most important questions that subscribers often ask us, and that's how do you tell a healthy balance sheet from an unhealthy balance sheet? In order to do that, I'm going to turn the presentation to our professors, William Kay and Nathan Mock, and they're going to go through a good balance sheet, a company like AAA rated Johnson & Johnson with only 26% debt, and that's obviously a key. And you're going to see with a strong balance sheet, a company that has literally an impeccable record of earnings growth. And we're going to contrast that to a company like AMC Entertainment, which is really below investment grade and really one step away from bankruptcy. The company's CCC plus and has 110% long-term debt to capital. Now, obviously, the bad balance sheets are what generated these kind of performance. So now, without further ado, I'm going to go ahead and turn it over to our professors, William Kay and Nathan Mock.
Hello, Nathan. One of the key issues I often hear is whether a company is healthy. And the job of the balance sheet is to show us the financial health of a company on one day. What do they own in accounting? What do they owe their liabilities? And what's the difference, their equity or net worth? And I want to get your thoughts on this. What do you think, Nathan?
Yeah, it's a great point. It's a big issue. It's something investors are always curious about. And I've got a few thoughts on general categories, and then we'll go through a couple of firms as an example, just to see how some of these concepts about financial health really work and how you can use FastGraphs to help you evaluate the health of a firm, and also to kind of do so quickly and in a way that I think makes a lot of sense.
Oh, that sounds great.
So there are different ways to think about what makes a firm healthy. But Bill, as you mentioned, I really think the financial statements is where we want to look. And I think the balance sheet in particular is going to tell us about health. But to me, a healthy firm should be liquid. It should be able to control its debt, and it should generate enough cash to meet its obligations. And so those are the three big categories that we really want to look at. And just to drill a little bit further into each of those categories, the first is really liquidity, which means what's a firm's ability to meet its short-term financial obligations. So we can think of certainly longer term obligations that falls under leverage. And leverage is more longer term type of borrowing. And it really gets into what's the mix between debt and equity. So how has a firm paid for its assets? Has it used debt capital, equity capital? What's the balance of those? What's the ability to handle the existing debt levels? That type of thing, it really falls under leverage. And then finally, we also do think profitability has something to do with firm health. So we want a firm that generates enough profit or cash to be able to not only meet its obligations, but hopefully provide some return and provide some cash back to shareholders, or to reinvest in the business to help them grow into the future. So those are the three areas. But I think it's always easier to see how this works with some specific examples. And Bill, I know you've done some looking at a healthy firm and an unhealthy firm. And so I'm curious to hear what you have to say on that.
Yes, Nathan, and a wonderful tool that helps me is Fast Graphs and Fund Graphs. So what I did is I went into Fund Graphs and I pulled off some of the key numbers that you're referring to and looking at those. So I started with Johnson & Johnson, and they are one of only two companies in the United States with a AAA credit rating by Standard & Poor's. And as of the end of December 2019, the end of their fiscal year for 12 months, I looked at how much cash did they have on the top of the balance sheet. This is liquid cash. 19.3 billion rounded up. Oh, wouldn't you like to have 19 billion plus in your cash account?
Yeah, that's a good spot to be in.
Oh, absolutely. We could live off of the interest on that cash for a few days, right, Nathan?
That's right. It would last us a bit.
Yes. Equity. Now, equity is the difference between what you own, your assets, and what you owe, your liabilities. So we take the difference between those two key categories, and there's 59.5 rounded up in stockholder or shareholders' equity. So assets minus liabilities equals that amount on this one day. However, now Johnson & Johnson does have some long-term debt, over 27 billion. But they can borrow that money at a very low interest rate. I think their effective interest rate is only like a little over 3% on that long-term debt. And they can take that money, put it to work. And as we can see in their net margin, they're making a great net margin as we move down here. So they can put that money to work and maybe make 20% off of it. So that's a good float between 3% interest and the 20% margin. They have total debt of 28 plus billion. But what I really like about Johnson & Johnson is their operating cash flow. Take the accrual profit and adjust it back to the cash from their operations, and they're showing 23 billion. When you take off what they spent for their capital expenditure, they still got almost 20 billion, 19.9 left in free cash flow they can use for other things. Now, they generated over 82 billion in sales revenue for the last fiscal year, and they had 15 billion in accrual profit net income left after all cost and expenses. So that's a great margin, 15 divided by 82. Now, long-term debt to equity, one of the key leverage ratios you talked about, Nathan, they've only got 46 cents in long-term debt to every dollar of equity. And when you take total debt, they've only got 48 cents to every dollar. So that's why they have that wonderful AAA credit rating.
Bill, I really like this example, and I think it shows the importance of all three elements of health. And, short term, they've got a lot of cash. Longer term, they do have a lot of debt, but as you pointed out, they generate a lot of cash to offset that, and their debt to equity looks completely reasonable. So I think you're absolutely right. You can see why they have the AAA rating.
Well, it's great to see a healthy company like this. Now, when I looked at another company, AMC, that's been struggling right now with the pandemic and all their theaters being shut down, and they're trying to start up and having some challenges there. Right now, Standard & Poor's is giving them a triple C plus rating. Now, why the difference between the two? Well, They do have some cash, but it's only 276 million. Now I know that's a lot of money to us, but to them, you compare it to 19 billion, it's not that much. And their equity is only 1.2 billion, assets minus liabilities. They do have long-term debt of 9.7 billion, total debt of 10.4 billion rounded up. And this is where you start to wonder a little bit. Operating cash flow, 579 million compared to J&J's 23 billion. You know, cash is king. That's what keeps you alive. And when you run out of cash, that's when you got to go borrow money, or you know, you get close to bankruptcy if you can't raise enough cash to stay in business. They only have 61 million free cash flow on this day, 12 of 2019. And when you look at their profitability, it was negative. They sold over 5 billion of theater tickets and popcorn, all those things they sell, but they lost 149 million in accrual profit. And when you look at their debt to equity, they're showing over $8 in debt to every dollar in long-term debt to equity, and total is 8.55 to 1. So there's quite a comparison there from good to bad, Nathan.
Yeah, it's pretty incredible difference. And, you know, just looking at the big three categories, AMC's got short-term issues with not a ton of cash. They've got longer-term debt issues in that they have a fairly large amount compared to their equity. And then their ability to generate profit and cash to service that also looks problematic. So it is a real contrast between these two. Bill, I was wondering, could you show where do you get some of this data from in Fast Graphs and Fun Graphs?
Yes, you know, it's a wonderful place to go to see these numbers and how they work visually. So when I go into Fast Graphs and look at the basic graph for Johnson & Johnson, I can see the orange line, their earnings, I can see their PE and so forth. But on the right side, they show me the S&P credit rating of a AAA. And this was as of September 17th, 2020. So really real-time information on that day. We can go into Fun Graphs and we can see what amount of long-term debt did they have on the last day of December 2019. And in the red box on the right, you can see there's that 27.21 billion on that day. Also, we can see their equity on that day. So the common equity, or the book value, assets minus liabilities on that one day, was 59.5 rounded up $billion in equity. So it's a great way to get in there and see these numbers, and you can see the trend in these numbers over a period of years. So
that's just what I was thinking, Bill. It's great. I like that you had the numbers as of one date, but it's also nice to see what's happened over time. And just visually, you can pick up on that very quickly here. You know, I think the bottom line with firm health is you really go back to these three factors, that it really boils down to liquidity, leverage, and profitability. How can a firm meet its short-term obligations? What does its longer-term obligations look like? And what kind of cash is it generating? And it's really nice to be able to find out answers to those questions so quickly in Fast Graphs and Fun Graphs.
Yes, and what you can see on the left side is we can look at the balance sheet, all these key numbers. We can go into the cash flow, see those key numbers, income statement, and even market value. So it's a wonderful tool.
Thanks, Bill and Nathan, for that excellent introduction on how to tell a healthy balance sheet from an unhealthy one. To the viewers out there, in the future, we're going to be doing a lot more videos like this. We'll be getting into even more depth on the balance sheet itself. We'll also be looking at other financial important statements like the income statement as well as the cash flow statements. But in addition to that, Value Academy will also be going through a lot of valuation metrics, how to value a business properly, how to know when a business is a good investment or not. And we're going to be doing that in a very comprehensive syllabus that we have planned for y'all. So if you haven't subscribed, please do, and ring the bell so that you stay up with this. I do want to remind everybody this will be totally free content. You can access it either here on the YouTube channel as a subscriber, or you can go directly to www.fastgraphs.com, and all this content will be free on our website. You don't have to be a subscriber to access it. So we want to thank you all for watching. We really look forward to going through this. We plan to do just an untold number of videos, and I think you're going to find that it's going to be a great way to really enhance your financial education. So we look forward to that. I hope you do as well. Thanks for watching.